Full cycle accounting question practice. That's what we'll be covering today. My name is Katherine Nally. I'm a CPA and I help accounting majors like you through graduation and beyond. I wanted to go over some practice problems with y'all today. I found a practice exam online from the University of Nevada, Las Vegas back from 2015. So I don't think this is going to help you if you by some chance do go to that school now, but I just thought it was a really good exam for us to walk through. I specifically want to talk about how we would go through the full cycle of accounting transactions, from transaction to general ledger to trial balance, income statement, balance sheet, all of those things. I wanted to walk you through the whole process with these examples. For background, it says for the past several years, John Adams has operated a part-time business from his home. As of April 1st, 2002, John decided to move to rented quarters and to operate the business, which was to be known as Adams and Family Inc., on a full-time basis. Adams and Family entered into the following transactions during April. Okay, we start with this first one, April 4th. The following assets were received from John Adams: cash, $10,000, accounts receivable, $1,500, supplies, $1,250, and office equipment, $7,500. There were no liabilities received. So first thing is the journal entry. We start by identifying what accounts we will be using. In this case, they gave most of them to us: cash, accounts receivable, supplies, and office equipment. The other missing account is going to be owner contribution because we want to make sure we record that John Adams is the one who gave this to us. The first easy account to talk about is cash. Cash is an asset. Assets go up with a debit, so we debit cash for $10,000. Accounts receivable, also an asset, going up. Debit accounts receivable, $1,500. Supplies, asset going up, $1,250. Office equipment, $7,500. Debit going up. No liabilities received, but in this case, we credit the owner contribution for the difference. On April 4th, we paid 3 months of rent on a lease rental contract, $4,500. Because this is for 3 months and not just 1 month, we're going to debit prepaid rent for the full $4,500 and credit cash for the payment that we made. Next, we paid the premium on property and casualty insurance policies for the year, $1,800. Now, it doesn't specifically say we paid it in cash, but we can always assume if it doesn't say otherwise that we paid it in cash. Cash is an asset. Assets go down with a credit, so we're going to credit cash for $1,800. And in this case, debit the prepaid expenses for the insurance. Next, we received cash from clients as an advance payment for services to be provided in the future, $3,000. Cash is going up in this case. Cash is an asset. Assets go up with a debit, so we debit cash of $3,000. Now, this one can be a little confusing. The client is giving us cash for services that we're going to provide in the future. In this case, it's not a revenue today because we haven't actually done anything today. What it is a liability of unearned revenue. So we credit unearned revenue for the $3,000. Next, we purchased additional office furniture on account from Morrison Company, $1,800. Office furniture is an asset. It's going up. Assets go up with a debit. So we're going to debit office furniture for $1,800, and we paid for it on account, which in this case, because we have to pay somebody this money, it'll be accounts payable. Accounts payable is a liability. Liabilities go up with a credit. Credit $1,800. Then we received cash from clients on account for $800. This is probably from the accounts receivable that we got from the owner at the start of the business. But we received cash. Cash is an asset. Assets go up with a debit. So we debit $800 and credit the accounts receivable for $800 to show that they don't owe us that anymore. Then we paid cash for a newspaper advertisement, $120. We paid cash, so cash is decreasing. Cash is an asset. Assets decrease with a credit. So we credit cash for $120 and we debit then the advertising expense for what we paid to the newspaper. Expenses ultimately decrease equity, and equity goes down with the debit, which is why we debit it. Then we paid Morrison Company $800 for the debt that we incurred on April 7th from when we bought furniture from them. So we're paying them money. We pay them with cash. Cash is an asset. Assets go down with a credit. So we credit cash for that $800 and we debit accounts payable to show that we don't owe them that money anymore. Next, we recorded services provided on account for the period April 4th to 15th for $2,250. So in this case, we performed a service for customers and they haven't paid us for it yet. Performing a service is services revenue. Revenue is an equity account and revenue increases equity. Equity goes up with a credit, so we're going to credit service revenue for this $2,250 and we're going to debit the accounts receivable to show that these people owe us money for the same $22.50. We paid our part-time receptionist for 2 weeks' salary $400. It doesn't specify, but we can assume we paid them in cash. That's how I like to receive my paycheck, so I'm pretty sure we paid them the same way. So cash is an asset going down. Assets go down with a credit. So we debit $400 and we debit salary expense for that receptionist for the same $400. Then we record the cash that we received from the cash clients for those fees earned April 4th to 15th, $31.75. This can be a little confusing, and this is where you have to read really carefully. We're not saying that we got payment from the customers that we recorded just a couple moments ago, the customers that paid on account. These are separate customers, separate additional customers who paid us cash at the time of service. In this case, they paid us $31.75, but again, cash for the services we provided at the time of service. So cash is going up, cash is an asset, assets go up with the debit. So we're going to debit $31.75 and we're going to credit service revenue for the same amount to record that they paid us cash at the time that we completed the service. Next, we paid cash for supplies, $7.50. Cash is going down because we paid it, it's out the door. Cash is an asset, assets go down with a credit. So credit cash for $7.50 and debit supplies, which is also an asset, to increase it by $7.50. Then we recorded services that were provided on account April 18th to 22nd, $1,100, similar to another transaction we did before. In this case, we provided services to customers before they paid us. So what they owe us is accounts receivable. So debit the asset of accounts receivable, it's going up by the $1,100, and credit service revenue for services that we performed, $1,100. Next, we recorded cash from cash clients for that same period for $1,850. So again, these customers, same time period, they paid us cash at the time. So cash is increasing, cash is an asset, assets go up with a debit, we debit cash for $1,850 and credit service revenue for $1,850. Service revenue is an equity account, it increases equity, equity goes up with a credit, which is why it gets credited. On April 25th, we received cash from clients on account for $1,600. So these are customers who owed us money, they're paying it to us now. Well, they're paying us in cash, cash is an asset, assets go up with a debit. We debit $1,600 and we credit accounts receivable to show that they don't owe us anymore. Accounts receivable is an asset. In this case, the asset is going down, which is why it's being credited. Again, we paid our part-time receptionist for 2 weeks' salary, $400. Just like last time, debit salary expense $400, credit cash for $400 because cash is going down. Paid our telephone bill for April, $130. Same thing, debit telephone bill, credit cash, $130. Paid our electric bill, debit electric bill for $200, credit cash. Another week of services. First, we're going to record the clients who paid on account. We're going to debit accounts receivable for $1,000 and credit service revenue $1,000. Then we record the clients who paid in cash this week. Debit cash, $2,050, and credit service revenue, $2,050. On April 29th, John received $4,500 from the company as his salary. In this case, even though he's an owner, we're paying him for his services as an employee, so it's still salary expense. Credit salary expense for the $4,500 and credit cash to show that it's going out the door, we're paying him. Next, we have to record the adjusting journal entries for the period. First, we had $150 worth of insurance, which expired in April. So because the insurance has expired, remember we prepaid for it before. And so the prepaid insurance was an asset on the balance sheet. But $150 of it expired because just time passed. We only paid for a certain number of months. One of those months is gone. Debit interest expense for $150 to show that it's gone, it's an expense now, and we credit the asset of prepaid insurance for the same $150. At the end of the month, we did a physical count for how many supplies we had on hand, and we got 1020 as the number of supplies. Well, if we look at our trial balance, we see that we had $2,000 worth of supplies according to the books. We did a physical count to see that we had 1020 left. That means that $980 worth of supplies must have been spent this month. So we're going to debit supplies expense for that $980 and credit our asset of supplies to show that it's decreasing. Our depreciation for our office equipment this month is $500. So the journal entry for depreciation is we debit depreciation expense for $500 and we credit accumulated depreciation for the same $500. Accumulated depreciation is a super weird contra asset account. I haven't done a deep dive on depreciation yet, but once it's posted, I'll link to that over here for your reference if you want to learn more. Next, we have to accrue receptionist salary for the full month of April. In this case, what's happening is we pay her every 2 weeks, and the payday just doesn't exactly fall on the last day of the month, which makes perfect sense. Very rarely will you pay someone for their services through the end of the month at the end of the month. So we just have to accrue a little bit extra. In this case, debit salaries expense for $20 and credit salaries payable for $20 to show that it was an expense in April, but we do owe it to her later. You remember we had some prepaid rent at the beginning of the month. In this case, 1 month of rent has expired for $1,500. So we're going to debit rent expense to show that we used it and credit the asset of prepaid rent to also show it's off the books. We have 1 fewer month of rent that's been prepaid. If you remember, we had a customer prepay us in the beginning of the month for services in the future. Well, by this point, we've earned some of it. We've done some of those services, whether it was a gift card or a contract, it doesn't specifically say, but we did perform some of those services for them. In this case, $2,000 of the $3,000 that they paid. But we're going to debit unearned revenue for $2,000 to decrease the liability, and we're going to credit service revenue to show that it's no longer a liability. We performed the service, we earned it as revenue. The question doesn't actually ask us to create an adjusted trial balance, but we have it in the solutions. So I'll put it up here for you to see. Next, we're going to create an income statement, which is super simple because they don't have all that many moving pieces. You can see we just have our revenue, service revenue, just list all of our expenses, add it up, total expenses, and we have our net income. Next, the question is asking us to create a statement of retained earnings, which I haven't specifically talked about in a video, but it's pretty simple. We start with our beginning retained earnings, we add our net income, subtract dividends, and that's how we get our ending retained earnings. Because net income and dividends are the only things which affect retained earnings, this just shows it out real nicely what it is. In this case, because we just recently started our business, our beginning retained earnings was 0. We add our net income for the month, the $45.25. We didn't have any dividends, so nothing to subtract, and that's how we get our ending balance of retained earnings, $45.25. We then use this to create the balance sheet. In this case, they've created a classified balance sheet, which just separates out current and long-term assets and liabilities. So our current assets include things that in the next year or so should get converted to cash, or less than a year should take for it to convert to cash, including cash, which is obviously already cash, accounts receivable, hopefully people will pay us back quickly, prepaid rent, we didn't prepay that much, prepaid insurance, same thing, and supplies, which are always current because we expect we'll use it pretty quickly. And that's how we get our total current assets. And then we have our long-term assets, also called property, plant, and equipment, which has our office equipment of $9,300 and our accumulated depreciation, which is negative because it's a contra asset like we talked about earlier, to get us our net property, plant, and equipment. When you take the $9,300 minus $500, that's the net of $8,800, and we add up current assets and the long term to get our total assets. Next, we have our liabilities, our current liabilities of accounts payable and salaries payable. And we count unearned revenue as long term in this case, I suppose, because they don't really know how long it's going to take for them to use it. But in most cases, unearned revenue is a short-term liability. That's how we get our total liabilities. As I talked about in a previous video, there are only 2 types of stockholders' equity: the contributed capital and the retained earnings, either money the owner takes out of their own pocket, contributed capital, or retained earnings, the net income of the business, which hasn't been paid out in dividends yet. So those are the only 2 line items here for stockholders' equity, and you add them up to get total stockholders' equity. And as you'll see in this balance sheet, our equation balances. Our total assets match our liabilities plus equity, and that's what the balance sheet shows. Next, we have to close the income statement and use our closing entries. In this case, it looks like the school just jumped straight to retained earnings. They don't use income summary, but that's really weird. And also they're closing the revenues and expenses together, which again is really not what I've seen when working with accounting problems. But that's another reason why it's important to know your school and your professor and how they want you to record things. So because service revenue increases equity, it's normally a credit. In order to close it, we're going to debit service revenue for the $13,000, and then our expenses are normally debits. So in order to close them, we're going to credit all of them, just list them all out. And the difference is our net income, which in this case, they're just crediting directly to retained earnings for 4525. Because we didn't pay out any dividends, we don't have any of those to close, but if we did, they would come in here, debit retained earnings and credit dividends. Then we create a post-closing trial balance, which is pretty simple. All of the balance sheet accounts don't change, and all of our revenues and expenses are zero. And that's it. That's how we'd walk through a full cycle accounting problem. I hope that was helpful. If you want a free cheat sheet to help you keep debits and credits straight, you can find that linked in the description. I'll see you in the next video. Thanks. Bye.